Welcome to Introduction to Business Management 111 online, offered by Harper College. My name is Dr. George A. Mochocki. This week we're going to be covering chapters 17, Accounting, and only one chapter this week, so that shouldn't be too bad. Seems manageable. Remember, I want you to start looking at your feasibility project and start working on that thing. You should be at least up to the first three portions of the conceptual map that I have on there on the feasibility study. Okay, so what do we have this week? Before I go on, you're doing well on the connects. You're doing mostly everyone's doing the connects. You already got this down the path. I'm not going to beat it to death. You've got your forms. You're doing pretty good. Most of you are pulling B's and A's out of this class. I got a few C's, a couple of D's. That's just because you forget the forms or you forget to do the connects. And once it's gone, it's gone. We've been already doing this. I think we're starting on week 12 or 13, so we should be all right. So this week, what we're going to be doing is we're going to be talking about chapter 17, accounting. Now, accounting is a little different than the next chapter we'll be talking about next week, finance. For this week, accounting. Accounting is the raw data. It's information coming in. How much did I spend? It's looking at ledgers. It's looking at journals. It's looking to make sure I put the money in the right expenses. Some people who have already taken accounting or accounting classes may find it not difficult. They say it's hard. It's hard because it's very detailed. I have to use the approved accounting procedures, the formats, what they call the GAAP, general approved procedures, how every business is looked at. So I may find easier ways of coming up with the answers, but here's the procedure, here's the way it's done, and it's very detailed. So when you look at accounting, looking at accounting system. Accounting systems, as you've done before, it's input and output. So what comes in comes out. So, but in inputs and output, only you're looking at when someone asks you, what's the language of business, you can see accounting, because accounting is looking at the expense, looks at my revenue coming in, looks at how much it's costing me, it's looking at I'm making a profit. It tells me when I have to pay my bills. So everything to do with money is accounting, right? But it's not telling me how do I make money on money. It's just taking information in. So you have QuickBooks, you have Peachtrees. Those are all accounting systems that once they're set up, it will put in the right ledger, into the right journal. It will categorize it, whether it's an expense or whether it's a capital, whether it's an operation, whether it's an what do you call it? It's a sales expense, or whether it's a motivational expense. All these different expenses, whether it's rent, whether it's wages, deferred wages, whatever it is. So every accounting, anything that comes in, it's like your body. When you wire up your body, it says here's your heartbeat, here's your blood pressure, here's your sugar level. All this information is a lot of information. Just give me raw data. What does it mean? It gives me some ratios. It gives me some, it should be in this area, but it doesn't tell me how to improve it. Next chapter in finance will tell me how to improve it. So, okay, so different types of accounting. You have managerial accounting. Managerial accounting is the most lucrative and the most profitable for any accounting firm, because managerial accounting looks at the expense side, it looks at the people, looks at the process, and what happens is there's the consulting side of accounting that comes in and tells you how do you what are you doing, how do you reduce your expenses and improve your profitability. And that could be your process could change, or you could buy something, some outsourcing, or buy a material, a different thing, or you have a better discounts or anything else. So that's for managerial accounting. The next one is financial accounting. Financial accounting is when you look at the year-end books, it provides your year-end books, and this accounting is important because it talks to the investors. Financial accounting looks at investors. If I, for some reason, have always been providing dividends, and that's after I've paid all my expenses, I have profits, and I'm not going to reinvest it into the business, but I'm going to provide dividends. And if for some reason this one year I'm not providing a dividend, the first thing people are going to think, oh, the company's having a problem, they can't pay the dividend. The financial accounting will send out to all its investors and to Wall Street, if it's a publicly held company, and say, hey, Motorola is holding back on dividends this year because we're going to be expanding into the Chinese market. We're going to be opening up a new mini tablet, or a new iPhone, or a new, what do you call it? Not iPhone, that's with Apple, but a new, what do you call it? Smartphone. And the money that we would normally give to our investors as a dividend, we're going to reinvest into the organization. So by next year, you'll get more dividends, but the company will grow, and your overall the soundness and strength of the organization will go go forward. So that's what financial accounting is. The next one's auditing. Auditing is the one of accounting that's very uh, not very famous, but where people see the auditors come in, they get all nervous. But auditing is the strength of accounting. What happened with the Enron, with all the crashes, is because the auditing section was weak and weakened down. And so a lot of people, if you look at Enron, when what do you call it? Arthur Anderson, the accounting firm. They had a consulting accounting, a managerial accounting was making money for it, but he also did the auditing. So now, if you're getting paid so much money from this thing, and you had the same person, the same company that's doing the auditing of the same organization, are you going to give it a bad audit? So the new rules, what you're going to find out in your form, one part of your form, what are the new accounting rules for auditing, or new accounting rules for even documenting information? Because what happened is the auditing and accounting they work together too close in hand. The new rules basically saying if I have my managerial accounting, they cannot be the same company that is doing my auditing. And every 5 years, I have to have another auditing. This way, I know for sure that my auditor is not ripping it off because I have another auditor looking. If you look at someone who's a chief financial officer and he or she retires or leaves the organization, and a new chief financial officer comes in and they do an audit, that's where you find out the discrepancies or something didn't look right or where money was being siphoned off because the auditor didn't catch it because the way it was a creative financing. So you always have to have that auditor, and the auditing helps me as an investor because I don't know anything about the company. I'm looking at the auditor's report. If I have a favorable auditor's report, and if I trust the auditor, then I'll basically invest in that company because I say, hey, the company, everything up front to this point is a solid, financially sound organization. But because you found out that some of the auditors were at the bigger companies that were coming up with some creative financing as to make more money for their organization or for their partners, or either one, is where the new rules and regulation came in to make sure that auditing has a place and is separately outside looking at the process and is not influenced by any other companies, either internal or the organization that's doing the auditing. Okay, so you have that. Look at different financial statements in the form. You're going to be doing like a mini income statement. You're just looking at last week when you look at the a couple weeks ago, you look at the pricing. You came up with your average pricing. Now you're going to take that average pricing and you're going to look at your average expenses. You're going to look at what your expenses are going to be, operating expense, your general expenses, and then you subtract that expenses from your revenue or your cost and see if you made a profit. I understand there's supposed to be a cost of goods in there. I don't want to confuse this because this is basically going forward. It's just a feasibility study. I'm just looking, am I going to get enough customers and at this right price from this new business coming in, and what are my expenses, my rent, my labor, my marketing, my sales expenses. After I put all those expenses in, will I make a profit? This is only a feasibility. I'm not going to go in debt right now, right now, but I'm just trying to figure out, is this project even worthwhile to go forward to the next step and write a full business plan and look at all a full income statement, a full balance sheet, and a full what do you call it? The three statements that you need from a business is a balance sheet that tells me my what do you call it? My liabilities and my assets, which is my owner's equity, and the next statement which I would be looking at. Remember, similar to what we had on the personal financing on your own net worth. And the next one is a cash flow statement, how much money's coming in and out, and a balance sheet that tells me my liabilities, my assets, how much do I owe, or how much if the business goes under and I have to pay off my debts, because the business pay off all my debts, and what kind of a structure am I? Okay, so that takes care of that. So you have the business, you have the balance sheet. Make sure you understand the balance sheet. Remember, a lot of times I look at balance sheet and someone say, well, you didn't even spend much time on the balance sheet. How do you know I did it wrong, right or wrong? Because the balance sheet's a balance. My assets should equal my liabilities and my owner's equity, so it should balance on there. Okay, look at the cash flows things. How do I make the cash flow? Make sure you understand the LIFO, FIFO system and the different ratios. When you look at the ratios that they're going to talk about from accounting, there just gives me like quick snapshots. If I look at my thermometer, my engine's overheating, it says it's overheating. I don't know how much is it, real hot overheating. It makes sense. It's just a ratio. It takes two components and it's taking me a ratio, so I just have a real quick snapshot of something to look out for. What you'll find out about different liquidity ratios, current ratios, leverage ratios, profitability ratios, activity ratios, and inventory turnover, those ratios only make sense for the same industry. Let's look at excuse me. Let's look at inventory turnover. What are ratios you're going to find out in your LIFO and FIFO. If I look at inventory turnover, how quickly I turn over inventory. If I'm a car dealership, average car dealership, if I turn over a monthly, maybe 5 cars, that's a good turnover for my, let's say for my mid-sized cars, maybe 3 or 4 cars a month. It means I'm doing real well. So my inventory is still fresh. It's coming over for the car industry. If I take that same 3 turns inventory and I take it for produce a month, if I turn over my bananas 3 times a month, what does that tell me? I got old bananas, I got rotten bananas, I got poor inventory. It doesn't make sense. So when you're looking at any of these ratios, you utilize the ratios against the benchmark, the best in the company. What are their ratios? So I will look, if I look at inventory turnover for cars, I would look at what's Chevy dealer versus Ford car manufacturers, what's their ratios for or inventory turnover for mid-sized cars versus foreign like Honda or what do you call it, Hyundai or Toyota, what's their ratio turnover? Now I could see, am I in the ballpark? So investors are looking at ratios. It's almost like if I go in there and says, hey, I weigh 180 pounds. Well, is that good or not? What's the ratio? I say, hey, 180 is not too, well, it looks so, it's okay if I'm 6'7" and I'm broad-shouldered, but if I'm only 5'8" and I weigh 180, you say, no, for your structures, animated, for your age, you should weigh 150 pounds. You see, so it's the same with the ratios. Makes difference. It's important and that you measure apples to apples, the same industry. So that takes care of it. So what do we have this week? You have one YouTube. Make sure while you're already watching the YouTube here. Remember, the YouTubes are 15, 18 minutes. I know, but it gives you a real quick snapshot what I'm looking for in the forums and everything else. You're going to read chapter 18. You have chapter 17 is Connect homework. We're 20 points. One quiz. We're at 20 points. You got 10 questions. Each question is worth 2 points, so that's not too bad. You have one form. And the form is a mini income. So you're going to, for this week, we're 25 points. You're going to do several things. You're going to do the form for your own feasibility study, and you're always going to go on the internet, and you're going to find out something that's, what do you call it, new rules and regulations that's pertaining just to accounting. So, and remember, when you find the websites or something, I'm going to give you one to look at the Small Business Association, but if that's very weak on that, find other sites and post it in there and keep the forum going. So remember, you're going to state your business. You're going to tell me what your operating expenses are, what your selling expenses are, what's your expense, and then you're going to take your pricing, you're going to subtract the two, and then you're going to come up as are your revenues higher than your expenses? And it's okay when you first start off a business. Don't expect you're going to make a profit. Most businesses won't generate a profit or break even. Hopefully you're breaking even, you know what I mean? But won't break even maybe for 2 or 3 years, 5 years before you start making a profit. But each time you have to understand, because right now at your new venture or new business or new product line, you don't have any historical data. Some of you may, but is that's going to work? Going to be the same data you're going to use, and you make an assumption going forward. Okay, so this way, if your expenses are higher than your revenue, you may have to have more customers, or you may have to raise your prices, or you may have to take a loan out to offset it for the next couple of years until you start getting a customer base and the business is up and running and becomes sustainable. A lot of business, when they start off, they're basically struggling. They're just making it, or they're losing money. So they make sure they have income or extra money or some kind of financing to offset, to pay for their electricity, their basic and general operating expenses, their wages, until the second year, third year, when they start making some money and they start generating a profit. Even if it's $1, you're still making a profit. Then after a couple of years, you're making a larger profit in return. Okay, and then the last part of the forum is find any sites or anything else that talks about the new rules and regulations for accounting. I think for the next 5 years, because what happened with all the company meltdowns, the financial meltdowns, everything's so tight, and the government put in a lot of new rules and regulations. So accounting, if you're going as an accounting major, you have a good thing for the next 5 to 7 years, because the rules and regulations are there. We went so strict on the large businesses, but the same rules and regulations will trickle down to the small businesses, and that's where the issues are coming out. Small businesses are tied up in red tape, and eventually those will loosen up. So anyway, so those are the two chapters. Remember, make sure you keep up with your Connect homework, keep up with your quizzes, make sure you do the forum. You have what do you call it? One forum with a mini, two parts in it, and you should be doing all right. Keep up on your feasibility homework. You should be already having most of the chapters pretty well done. We're already in week 12. You only got 4 more weeks, and you're going to be supplying after Thanksgiving. You'll be supplying your feasibility, or Thanksgiving or Christmas or whatever in the next couple of weeks. Your feasibility. I forgot what holiday I'm in. Your feasibility study, and going forward. So let's make sure we do this well. And my name is Dr. George Mochocki. This is Introduction to Business 111 online, offered by Harper College in Palatine, Illinois, utilizing Blackboard Course Management System and McGraw-Hill Integrative Software, Connect or Learn Smart. And I'll see you in the forums, and have a nice day. Bye.